Federal Reserve hopes another aggressive rate hike will help it control inflation in light of prices rising at their fastest pace in a generation. According to Wall Street, the Fed will raise its benchmark interest rate by 0.75 percentage point on Wednesday. It will be a tough job for the central bank. Inflation should be reined in without triggering a recession. Fed Chair Jerome Powell and his colleagues are trying to do this by tackling demand. They are pushing up the cost of credit, what consumers and companies pay to borrow money, and they are trying to deal with a jobs market the Fed chair has called unsustainably hot, where wages are rising fast because many businesses are paying more to find workers. Powell sounded confident in recent testimony before Congress despite the difficulty of achieving a soft landing for the economy. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses, Powell told the Senate Banking Committee last month. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. In order to accomplish this, the Fed is raising interest rates. However, this is not an easy or painless process. The unemployment rate, which is close to its pre-pandemic low, will rise as policymakers continue to raise rates. The Fed would like those adjustments to be made in a measured way, but that is easier said than done. Inflation rose by 9.1% in June from a year earlier, and the Fed is tackling a problem it cannot control. Demand surged as the U.S. emerged from the darkest days of the pandemic, but the central bank cannot fix supply chain issues and end the war in Ukraine, both of which have contributed to higher gasoline and food prices. Economy continues to create jobs, but housing has slowed. Powell and his colleagues on the Federal Open Market Committee are closely tracking economic data, but they have been mixed. The price of goods and services did not peak in May, on the one hand. Increasing energy prices contributed to a rise in the Consumer Price Index in June. On the other hand, the labor market has remained strong. In June, it added 372,000 new jobs, more than Wall Street expected, which brought the total number of jobs added in the first half of the year to 2.7 million. Meanwhile, the housing market has been slowing down, thanks to higher interest rates. According to Freddie Mac, the average rate on a 30-year fixed-rate mortgage is now 5.54%, close to double from the beginning of the year, which has iced out many buyers. New home construction and sales have also declined. Stocks are another factor to consider. S&P 500 is down about 17% this year, while Nasdaq, which is in a bear market, is down about 25%. Later this week, the Commerce Department will release its quarterly report card on economic growth. In the first 3 months of the year, gross domestic product shrunk by 1.4%. There's a lot of evidence that economic growth has slowed over the first half of this year, says Ryan Wong, a U.S. economist at HSBC. Economic numbers are difficult to process, but there's no clarity in the data. Michael Gapin, the head of U.S. economics research at Bank of America Securities, says, crosscurrents make these numbers difficult to process. When you have data points that are in conflict with each other, you have to ask yourself, which ones do you believe? He says. Trust the instruments that you believe in. The distortion of data tends to diminish over time, according to economists. As an example, the Labor Department revises its monthly jobs numbers, and the Commerce Department's first estimate of GDP will be released on Thursday. But in this moment, it is hard for Powell and his colleagues to be patient. Inflation has become a political issue because rising prices are weighing so heavily on consumer sentiment. According to a recent Morning Consult Politico poll, 65% of registered voters believe the U.S. economy is currently in a recession. That's despite the fact that a recession hasn't been declared by the National Bureau of Economic Research, the nonprofit group that officially makes that determination. Doing nothing at this stage, not getting on top of the inflation problem, likely means course correcting later is even harder, says Gapin. If inflation becomes entrenched, and long-run inflation expectations move higher, history says breaking that spiral is much harder, and the downturn would likely be much deeper. Some prices are coming down. Economic analysts are scrutinizing the data for signs that the Fed's policies are working, like Powell. The Mastercard Economics Institute's U.S. chief economist, Michelle Meyer, sees some promising signs. Oil has been trading lower, and gas prices have fallen. According to AAA, the average price for a gallon of regular gas is $4.33, which is about 69 cents lower than its record high, set in June. If you look at a broad range of commodity prices in the markets, they are starting to come down, Meyer says. Inventory levels are starting to pick up for certain categories. Supply chains are starting to open up, so the cost of production is coming down. Powell and his colleagues may be able to use those data to boost their confidence that what they're doing is working.